Hello and welcome back to my series on economics and finance. Today we're going to be covering quantitative finance, arguably the highest paying job you can get straight out of college. Quant finance roles are known to pay between anywhere from $150,000 upwards and over $500,000 on people's first years out, depending on their bonuses as well. Typically, the compensation system for a quant role would include a very simple base salary. Typically, it ranges from $100,000 to $150,000 plus a bonus. The bonus is discretionary, but depending on your performance at the firm, this bonus could be upwards of double your salary, if not more. So there are certain people who, if they're very good at math, will go and become quant traders at a fund, say like Jane Street or Hudson River Trading, and they will get a base salary of about $100,000 to $150,000. But on top of that, because their performance would be very good, they can end up with a performance bonus of say over $200,000, maybe even over $300,000. These jobs are very competitive and it's not really for everyone. To become a quant, as it's a very competitive field, you're more than likely going to be required to have a background in either programming, math, or statistics. Finance and economic backgrounds are typically not quantitative heavy enough to be accepted into these roles, although there may be some exceptions, but typically you would want to go to an Ivy League, a top 20 university, study math and be very good at it on top of winning some math competitions or some hackathons, and typically you go through a whole bunch of rounds of interviews. You may have to study things like the Green Book, which is a book created for quant interviews, and study very in-depth math having to involve stochastic calculus, statistical modeling, and just very complicated systems that deal with this notion that certain variables are not unpredictable. That there are certain variables that are predictable, and if you can find out how to predict them, you can profit off of them. And one of the most profitable is being a market maker. Basically, meaning that a lot of these quant firms will engage in kind of facilitating buying and selling activities, and they'll make like a very small cut. So, for example, if you buy a stock at the market open, meaning you're going to take whatever price the market gives you, say you want to buy Apple's at 100, that $100 price is still a bit variable. It could go up or down a few cents, and you would still buy it because you bought at the open price. It's still going to be around $100. And because of this, the quant firms take advantage by buying the stock that you're trying to buy and reselling it to you at a slightly higher price, maybe even a few cents. And they will do this hundreds of millions of times a day and make a huge profit in the process. If you enjoyed this video, stay tuned and follow for more.